This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today on the show, I have Brendan Moynihan. Brendan wrote a book which first came out about 20 years ago called What I Learned Losing $1 Million. It was a profile of a trader named Jim Paul, along with Brendan's ideas and thoughts about essentially the behavioral finance, risk management, and loss-taking strategies that all great traders acted on, that there were some commonalities there. So it's kind of a two-part thing where Brendan took this great story from Jim Paul, who's no longer with us, and he laid out all of his views on trading. So this is a really kind of timeless type conversation. We don't go into everything. Obviously, we're talking about Brendan's book. I do implore you to take a look. It's worth the read, worth your time, and hope you enjoy the interview. Let's jump right in. Brendan, thank you for joining me today.
Happy to be here.
So this is an interesting book. What I Learned Losing $1 Million. I think most people, if walking through the bookstore, would say, no, thank you. That title's not sexy. And I know as a guy who was pushed on my first book to have the word millions in the subtitle by the publisher. So.
Well, yeah. And I mean, the idea was that I was put off by so many titles out there on, how to make $1 million in the markets and, different markets, that I never understood why an author would do that. I mean, if it was such a good approach and methodology and system, why would they try to sell a book to people? Why wouldn't they just take their methodology and make their millions and, buy an island and be happy? So, I was put off by those and found that trying to emulate what was set forth in there did not make millionaires out of the people who were buying them. So this was a different twist, and it was a long, evolutionary process to kind of boil it down and get it into a working theory. But the basic premise is that there's many ways to make money out there as there are individuals in the market, and there are relatively few ways to lose it. And I believe I've identified what those are, and then put them into the form of a parable so that people will be more likely to remember the lessons, having attached it to a person's, personal journey.
Well, let me let you jump back. So the first edition of this came out in 1994?
Yeah, the book came out in October 1994. It was self-published because we did not like the economics of the book publishing industry. So we self-published the book, and the day it came out, it got a byline on the cover of Forbes magazine. Mark Hulbert did a full article on it, and the byline was, "Biggest mistakes investors make, are you guilty?" Which was nice free advertising, and got some publicity pretty quickly, and the book broke even in about 2 months, and then we were sort of off to the races.
Well, let me take a step back so people know a little bit about you and your co-author, who is no longer with us, Jim Paul. Why don't you go ahead and outline the relationship and how it came together, and a little bit about both of your backgrounds before we get started.
Okay, well, Jim's details are outlined extensively in the book. We go back to his childhood and sort of trace things through, but basically, he landed in Chicago in the late 1970s, early 1980s. And within 6 months was on the board of governors at the Chicago Mercantile Exchange, a very rapid ascent. But that just capped a long career of him. Everything he touched turned to gold. And in the course of the book, you'll see he got involved in a market, and then in 75 days lost 1.6 of the $1.2 million that he had, leaving him down 400 pretty quickly. So he had to go back to work. And then years later, I wound up working for him at a Wall Street investment bank. He was director of futures research, and I was the currency strategist. And in the day that I left his employ, he took me to lunch and told me a little bit about this story. and said, somebody said I should write a book about it. And I said, well, I can write the book. We can take your story and marry it with my theory, neither of which would sell by themselves. But if we married the two, I think you'd have a package that would appeal to people. So that started this, 4 or 5 month, back and forth on the phone. And then finally I went to Chicago, spent a weekend at his house, tape recording the story, and went back and spent Thanksgiving typing it all out. And then I married my information with his story. And that was the walk up to there. My background is I have been in the business about 25 years now. I was originally a bond trader in Tennessee, and then moved to Chicago and became a commodities trader. And that's eventually where I met Jim. And in the intervening years, I migrated on to being a currency trader, and then I quit for a long time and went home to help raise my children. I wanted to be around for that. And I came out of retirement in 2006. And I now have, I wear a couple of different hats now. I'm not sure. I don't know if those would be of interest to people or not, but I wear a couple of different hats now.
Okay. Well, we'll jump into that as we go on here. One thing I should add is that when I look at the things that I've written, a few books here and there, I find that actually a lot of the stuff that you have in your book, the lessons, the thoughts, the ideas, are almost all in my books too. It's the timeless wisdom. And I think the difference when I look at what I've done and what you've done is I've picked the example of some of the winners to show people how some of these lessons and these timeless precepts have been applied. And you picked a really interesting direction to go. Instead of picking the winner, you picked a loser to make the point, which I think is really creative.
Right. Well, one of the things that this is, like I say, this is a long time ago when I had the idea gelling in the back of my mind before I met Jim. I had the thesis for the book mapped out, but I thought it was very dry and clinical. And what actually did it for me was I remember hearing someone ask what made a Time Life photographer so exceptional. And the Time Life photographer said, well, imagine going to a domestic violence scene where a wife, after years of abuse, has killed the husband, and the police are in there drawing the chalk line around the dead body of the husband, and the news, the other news photographers are in there taking pictures of the body and the police or whatever. The Time Life photographer takes the camera and turns it away from the dead body and points it at the wife sitting in the corner with her head in her hands, after what she's done. So it struck me that, looking in the opposite direction is really, the way to sort of try to get to the heart of this. And again, I was put off by all the How to Make $1 Million books. So.
All right. Well, let me take it back, and I'm not going to attempt to go into all the details. People are going to have to buy the book and read it, and it's definitely worth buying the book and reading it just for it's a nice, quick kind of good read. And look, some people are going to read it and once again not see what they imagine is the secret sauce and probably just be dismissive. But for those that are in the know, they're going to know that it's all there.
Right. I'm not going to appeal to everybody. I understand that, but I would just say the book has been out there for a long time. The beauty of the internet is that you can then go read reviews that stretch back a number of years at Amazon. I would say that, to the best of my knowledge, it's the only book that got a nice positive praise mention in Nassim Taleb's Black Swan, as well as in his most recent book, Anti-Fragile. And I do not know Nassim Taleb. That's
really cool. He's a guy who doesn't give out a lot of praise, so that's pretty cool.
That's my understanding.
So, and he writes good stuff. So, and he's spot on. Let me take it back to a couple of the early things that happened in Jim's life, and because I think people can relate to this. And once again, we're not going to go into all the details. People are going to have to go read the book, but the idea that he seemed to be really influenced early on, and I think a lot of people can relate to this, that just make the money. Don't worry about how you make it. Now, he wasn't talking about illegal things, but right. Just make the money. And that seems to maybe have been because he was influenced by seeing a lot of, let's say at the country club when he was younger, he was influenced by seeing a lot of successful guys, with a lot of swag running around, pretty wife, nice car, stuff like that. But that's probably a bad place to start, saying that the money's your only motivator.
Oh, yeah, I would agree. And this is, after, being in the business for a little bit more than 25 years. I remember some of the early readings I did on some of the traders. I think the book was The New Gatsby's by Tamarican. And he said, one of the traders in there said, I have a healthy disrespect for money. And that sort of stuck with me, that, in some of the top traders, if you read their interviews, Tom Baldwin, for those of you who have gone back and, I'm dating myself here, obviously. But he said he counted ticks. He didn't count money. He counted, he was a pit trader, but that's what he did. He counted the number of ticks that he was up or the number of ticks that he was down. He wasn't really translating it into money. So, those who are enamored with, the money side of things, I think do start to lay the potential trap for themselves, especially if they've had a run of successes, because then they begin to extrapolate that. They begin to personalize the successes. And inevitably what that does is that they wind up personalizing the loss. And that's where the trouble starts.
Well, let me keep getting up, because we're going to get to, obviously, you've mentioned it here in the beginning, that there was a fairly calamitous several month period in 1983, I believe, for Jim. But leading up to that, now when he got to college, he had seen some of this being around some success at a young age, got to college and kind of just figured out a way to game the system. Would that be a best way to describe how he was going through? But he everything seemed to have kept falling his way.
Yeah, but and that's just it. I think he stumbled into it. It wasn't like he did things, illegally or wrong or broke rules. But just, for example, when he went through Rush, in college with his friend, after going to a couple of the parties, they got tired of it. And so they just called up the house that they wanted to join and said, we want to come over and get our pledge pins. And I guess the house was just so taken aback. They just did it. So I wouldn't call that necessarily gaming the system. He was just very brash and, stumbled into success very often rather than being conniving. You know what I mean? There
Right.
wasn't anything, evil about the way he went about doing that, joining the fraternity. He was brash and just stumbled into success. And there are just, a number of those sorts of episodes in the course of his life that led him to that. He did it same in Chicago. He goes to Chicago in 6 months. He decides he's going to run for board of governors. So he buys a 3-piece suit, gets all decked out and dressed up the way all the other people who were running were still, dressing all ragtag. And all of a sudden he's on the board of governors. I mean, he just stumbled into it.
Now, he did mention, though, that even in college, he started to think he was better than everyone.
Yeah. He recognized, and I call it the Midas touch syndrome. He recognized that he just had this knack for things going his way. He never really had any major setbacks in the course of his life. He was very gregarious. He was very personable, to the extent that he thought he was better than other people. That was not a look down your nose. It was that he just had a gift for doing things a little bit unconventionally and then having it work out for him where he came out on top.
Now, so when he got out of school, though, and you said he made his way to Chicago, I think Chicago was after he was in Ohio, though. He started as a broker. He came into the brokerage industry.
Yes, he was a lumber broker. Right, exactly. He was in the lumber market.
So now a few people out there might say, well, you're saying not conniving, and it didn't sound like it from the book, but a lot of people might not have the most fond feelings for, let's say, a commodities broker in the 1970s and 1980s.
Well, you'd have to be of a certain age, I guess, to have that feel. You know what I mean? Because I think that today, I don't think that that industry carries whatever connotations might have prevailed, back in the 70s. But I mean, they did a lot. He was doing a lot of institutional business, which I think it comes out in the book. They were dealing with potlatch up in the Northwest. They were big brokers because they were executing large orders for institutions. This wasn't, people trying to quote unquote take advantage of small traders. And a lot of it was, as it comes out in the book, a lot of what went on in the 70s, a lot of what was going on in commodities had to do with tax straddles and straddles involving tax implications for people trying to lower their tax bill. And that comes out in in the book as well. So the clientele for him was was basically sophisticated. It wasn't them out poaching
Gotcha.
small 1 and 2 lot traders.
Well, we're going to, as we end up our conversation today, I want to jump into, because I can kind of see when I read the book, as you described that you wanted the parable and then you had your premise laid out. I can kind of see how that, now that you explain that to me, I can see that in the book how you are combining the elements. But before we jump into some of those elements, I want to kind of get to ultimately, because here's Jim, he's riding high. He's coming, I think in 1983, he made $250,000 in one day.
Yeah, $248,000. That was probably the pinnacle of this trade. He basically had migrated from lumber into commodities in general and was trading from upstairs because the high interest rate environment in the early 1980s, for those of you who remember it, once they deregulated, fully deregulated interest rates in 1980, they really kicked in 81, peaking on October 1st, and it just really killed the housing market. So he migrated into soybean. He had a friend who had this idea about soybean oil and what was going to happen, and so they got involved in this trade. And he had on a limit position. At one point, he had on more than a limit position. The exchange had to make him back down. And so he was just basically, an upstairs trader, a raw commodities trader for a story that was going to unfold. And they did. He made $248,000 in one day, and he thought that he was just on top of the world. I remember him saying, it's like you expect God to call up and ask if it's okay for the sun to come up tomorrow morning, and after thinking about it for a minute, you say, "Yeah, go ahead."
Well, it's interesting. As I was reading the book, and something popped in there that was kind of relevant to my world, having written a book on Richard Dennis and the Turtles. And so I noticed it was right during this period, though, Jim had heard that perhaps Rich Dennis was on the other side of his positions.
Yep. On that trade, that was what they were hearing that Friday, that Richard Dennis was on the other side of the trade. So on a day that Jim made $248,000 with a limit position in soybean oil, Richard Dennis, I don't know what the size of his position was, but one assumes that he traded in fairly large size. Maybe a fair assumption, maybe not. But they thought, not only are we going to make a pile of money, but we're going to go down in history as the guys who took down Richard Dennis. So yeah, he had a lot of chutzpah.
Well, it's interesting that passage forced me to go back and look at my research to find out what Dennis's performance statistics were month by month for 1983, and he was up big for September and October. Nearly 40% he made in September and October. Lost a little bit in November, but it was almost like, and he had lost money. He had lost money in July, August, and I think in September. So it was, you could almost, not that Dennis was only trading bean oil. He was a much larger trader.
Exactly. But it's interesting you did that because the window, like I said, it topped in the market topped in early September, and that was when Jim had the record day for himself. And so that June and July, where Rich Dennis was, maybe underperforming and not doing so well, that's the window where Jim was making a lot of money. And then on that one day, they hear Rich is on the other side. So that September and October, when Richard Dennis is making money, that's when Jim is losing it all. That's the 75-day window where he just gave it all back.
Now I have to, because to some degree, and the story kind of changes from here, because this is the moment where Jim kind of says, hey, he has the meltdown. His life changes. Literally, it's the point where they're coming into his office and taking everything out, and he's out of money.
Yeah. Yeah. And he's down $400,000 too.
So he goes about, which, I think this is something everyone does. In fact, I started doing this in 1994 when you were putting this book out. But I was like, how do they make the money? How do they do it? How do the big guys do it? What do they do?
Right. And so, what I had done, in the late 80s is I had gone through the interview books, and, the interview format actually started with a magazine called Inner Market Magazine.
Yep.
Put together by Kevin Coy. And years later, I actually worked with Kevin and Pete Stottlemyre in Pete's Market Logic School venture that was running in the late 80s.
I have the Inner Market book, by the way.
Well, and so that was the first interview book, and then Jack Schwager, who wrote the foreword to the second edition of the $1 million book that we're talking about, he wrote Market Wizards. And so I went through all the interview books and all of the other books like the Dow Jones Averages by Goodspeed and Passionate Investors. There are a couple others out there that either were profiles or interviews with these master investors and traders. And I literally, wrote down what they said to do. And what I found was what, one or two or three or five said to do, another group said never to do. Just quick example. John Templeton says, diversify your investments. Warren Buffett says, concentrate your investments. If you have a harem of 40 women, you never get to know any of them very well. Now, that's very 30,000 foot view, but even at the more micro level, these people contradicted each other on how they went about making money. And so I threw up my arms and said, well, then it's just, this is pointless. So I decided to do the Time Life photographer thing, and I went back through the books and said, okay, what do they say about loss? It's the only topic they agree on. They don't tell you necessarily how they go about controlling loss. Warren Buffett says there are two rules to investing. One, don't lose money, and two, don't forget rule number one. So if you go through, the only topic that these people, all these traders and investors agreed on was loss control. So I really felt like there was, a ripe environment for me to, do the research and boil it down and take my experiences and what I had gone through. And then that's where I mapped out, my sort of clinical approach to what was going on. And it's funny because when I finished the book and gave it to Jim to look at, he comes back and says, I know how you got my story part of it because you tape recorded it and then you filtered it and you rewrote things or whatever. He said, but how do you know about all this loss stuff? This is exactly what I was going through. And I thought, you are so vain to think that you're the only guy who's lost money. I may not have lost $1 million, but the process is the same, whether you lose 5,000, 10,000 or 50,000 or $1 million, it is the exact same process that people go through, once you've personalized this thing, and these are losses due to the psychology part of what we bring to the table. This is all very much art. It's not science. And once psychology enters the equation, this is the three-step process that everybody goes through.
So, Brendan, let me ask though couple things that I noticed. So, some of the big traders that you mentioned in the appendix, Jim Rogers, Templeton, Warren Buffett, Paul Tudor Jones, W.D. Gann, and others. You didn't mention. I mentioned there was the call out about Richard Dennis in the book. Was there some discussion? Because look, at the time during the 70s, early 80s. Some of the most successful commodities traders, especially in the futures arena, were the trend following guys, the technical trend following guys. Was there any thought to mentioning that at all?
No, because I wasn't really interested in how do you make money. I really wasn't. I was interested in how do you keep what you've made? Jim obviously knew something about how to make it. He didn't know how to keep it. And I think that's true of most people. We really didn't want it to be like a how-to book on, making money. It was what not to do. Regardless of what your methodology is, whether you're a trend follower. Paul Tudor Jones says, I've missed a lot of those middle moves, but I've made a ton of money at the market turns. So it's like, well, I didn't want to get into the competing approaches to how they all made money. I really wanted to, that was ground that had already been covered. I don't know that anybody had boiled it down and said they all contradict each other, but I wanted to focus on the one topic that they agreed on in an environment that I don't think that anybody had really mapped out.
Yeah, there's no doubt that I never wrote about this myself, but there's no doubt that it was an exceptionally wise direction to take to say they contradict themselves, because they do. And I think a lot of people maybe see that, but they don't write it down and actually state, gosh, I'm reading all these contradictions from these guys that are all multi-billionaires. This is unusual.
Right. And I think what they do is when whatever approach they're taking stops to work, they go shop it and find another to lend credence to the new approach or the new tack that they're taking. And so they wind up changing horses in midstream, and they're looking for someone to ratify the position that they're in. And invariably they'll find someone out there to say, yeah, okay, you should, stay the course while the position is deteriorating in a profit situation, or whether it's, converted into a loss and getting worse.
I agree with you completely on the idea of what you pick to focus on, the loss idea, the behavioral finance, the risk management. I think I would add to the audience out there, though, too, that it might be worthy of their time to go take a very detailed look at how some of these big traders do make their money and try and draw judgments from that too. It's because you cover one aspect of it, and it's probably the most critical aspect. I mean, look, what Larry Height was always fond of telling me, the only thing I can control is how much I can lose.
Yeah, it's funny. I met him briefly about 2 years ago. There was a guy in New York who bought the $1 Million book and then struck up an email correspondence and apparently worked for Larry Height and wanted me to come in and meet him. We just sat and had lunch, and he echoed a lot of the things that I was saying, and which you've just ratified. It's the same thing. Yeah. And that's the thing. The book was not intended to be, a one size fits all, for how to go out and make money in the markets. It is intended to be on the shelf as a reference and to be read, once every 6 months. And you don't even have to read the full story every 6 months, right? Read the second half of the book every 6 months as a reminder to complement whatever approach that you are taking. And I agree with you. They should study the masters and how they go about doing that. But then they need to latch onto one of those that suits their personality and risk tolerance, and not then go start jumping around among those different, success stories when a position starts to turn against them.
Yeah, it's funny. One other kind of side note about Richard Dennis, he was actually launching the turtle experiment with one ads in that fall of 1983.
Interesting.
Right at that time that all this was taking place.
Yeah, that's funny.
Yeah, yeah. So let me. One thing. There's another line that I caught in here that I wanted to steal from you, but I'm trying to figure out where to steal it and where to put it. But the idea of a profit motive versus a prophet motive. Why don't you run with that? That we could have you could have a week-long class on just those few little words.
Oh, no, absolutely. And I think the best way to sort of couch it is, I divide the types of participants in the market, and people tend to confuse which type of participant they are. And what they fail to realize is it's not a function of the environment in which they're operating, but rather the behavioral characteristics that they display. So what I mean by that is there are investors, there are traders, there are speculators, there are bettors, and there are gamblers. An investor wants to be parted with his capital for some period of time in the expectation of receiving rent, dividends, or interest, all of which are paid periodically, quarterly, monthly, semi-annually. And so you plan on being parted with that capital for an extended period of time. A trader, to my mind, is a market maker, okay? Which, well, others are kind of going away. The book, again, when I wrote the book, market makers were still, plenty and abundant. Speculators are buying for short-term price appreciation or selling short for depreciation. So their time frame is collapsed from that of the investor. Bettors are interested in being right. You and I can have a bet on which team is going to win the game, and I'm going to go with my fealty, right? Like if whoever I don't follow sports, but I mean, if I had a favorite team, I'd say, well, my team's going to win, and you could say your team's going to win. You don't have to bet any money on it, right? But the whole point is, who's right, okay? And then gambling, is a disease, and I don't say that I'm not a qualified psychologist to say what the issues and problems are there, but we can identify certain behaviors that accompany that affliction and addiction, and for them, it is the adrenaline. It's being able. It's just money is just a ticket to the game. They just want the entertainment, but too often, people get interested in being right. And I think this comes from school, where you lose points for getting wrong answers on a test. So if you are losing money, you must be wrong, and that's something you don't want to be. And so you're more interested in, okay, it's not about money. It's not about making money. It's about being right. And that gets people on a slippery slope toward accepting a process that allows that loss to start to accumulate. And they go through 5 stages. They go through the 5 stages of internal loss once they personalize this position. A money loss should be an external position, an external event. But like you lose your keys, you don't personalize it and go into a depression. But you start losing money, you start going through the 5 stages of internal loss.
You go into some extreme detail about loss and behavioral finance and all of these issues, but as you're making this point about loss, I was thinking though there's one thing in the end of your book that I don't think you would really kind of hold out as something to. For example, you mentioned Gann in your appendix, and you said that he had 264 out of 286 trades successful. I'm guessing though that you probably, if you would have known years in advance you'd be having this crazy interview with me, that you probably would have put a little clarification there, because I doubt that you would even think it's possible for most investors to try and get 264 out of 286 trades successful. And I don't think any of the masters that you even put in the book did that. I think that's just a thing with Gann saying that.
Right. And I think that what all I was trying to do was for people who weren't familiar with some of the names, because I intended the audience to be broader than just people who are in the futures market and those in the securities market. And as you've seen in the book, I mean, I use a number of examples from business because I think that the same principles apply to entrepreneurs, business ventures, CEOs, people who personalize their successes, can walk right up to the edge and then generate a colossal failure in business in general. And so since my subject matter was the futures market, and I was doing a list of names who were prominent in that industry, that was more for the consumption of the non-securities and futures market readers who might look and say, well, who are these people? Who is Paul Tudor Jones? Who is W.D. Gann? You're right. I wasn't saying that people ought to expect to have that kind of a track record. It was just the appositive that went with his name in the literature to say this was a person of great stature in the industry, and this is why. Same thing with Jim Rogers. I mean, listed. Why is Jim Rogers well known? Well, because of Quantum Source Fund and so on. So I wanted to put that in there so people knew what their sort of credentials were.
Well, I think it was a pretty bold and wise stroke to put the word entrepreneur in there, because I think that's a word that I think to have any business success and being a successful trader is being a successful businessman, and the first word is really entrepreneur. Everything else I think comes below that headline. So I agree with you completely that you put a lot of the entrepreneurial examples in the book. Yeah,
and we got a nice endorsement from a professor who taught entrepreneurship at a university, and because I wanted there to be endorsements from more than just the securities industry. I wanted there to be people who were in other areas to sort of weigh in and have some sort of input. And Jim found I'll have to reach for this guy's name, but he's big in the sports industry. Oh, I don't know where that. I'm not sure I can reach for his name. Just now I'm showing my age as well, right? But he's a sports commentator, and talking about how it applied to to his mind, it applied to even to athletes. That you start personalizing that success and you start to get sloppy.
Well, I think it's making the point that you can. That at some point in time, there has to be an uncle point. I mean, this is I think a lot of the thrust of your work. There has to be an uncle point. At some point in time, you're no longer a hero. It's not about being right. You are simply about to go bankrupt. So you can't do that. You can't go bankrupt. And I think you also have to play these things out long before you ever put money on the table. If you have money on the table, that's where the danger happens. If you don't have the plan before you start.
Right. And so I go through and distinguish between discrete events where you bet on a game or you bet on the roll of the dice and the event ends all by itself. You don't have to do anything. The horse race ends, the game ends, it's all done. You can bet money on that and it's not any big deal.
Versus continuous.
Right. This is a continuous process. And once you put the money down, you are now susceptible to, a series of events that lead you through these, again, 5 stages of losses that allow that thing to grow because it doesn't end. The market might, and even at the time I wrote the book, I mean, yeah, the market's closed. Not anymore. I mean, we're basically 24/6, right? And so this is a continuous process. And if you're trying to make the decision after you're in the position where you're going to get out, then in my mind, you've made a big mistake. Identifying that uncle point on the front side, and at a base level, it has to be an amount of money because, like you said, you can't go bankrupt, right? Heroes die on the battlefield and cowards live to fight another day. If you want to be out there, you need to know on the front end what price and or what set of circumstances, news, lack of news, the unemployment report, whatever it is, what conditions, if then scenarios, are going to make you get out of this thing. And in my mind, that order needs to be put in first. It really forces you to say, okay, get me out here. And then, okay, now I'll get in. And, you turn that over to somebody else to execute, and you're not allowed to monkey with it. Not in an expanded direction. You want to monkey with that, that price level, following your position in the event that it starts to unfold and whatever methodology. Again, I'm not advocating a methodology. I'm just saying that without that parameter clearly identified before you immerse yourself in the market, you're leaving yourself open to a host of problems that arise because of psychological factors that will, lead you to lose more money than you can afford to lose.
It seems so simple, but it's so hard for people to grasp this idea. I mean, that we're not sitting here having a sexy conversation about how much money you can make, and we're sitting here telling people that the most important thing is to know how much you can lose before you ever start the game. It is so decidedly unsexy. There's nothing attractive about the conversation, except when you understand how important it is. And then when you understand how important it is, you're like, this is the coolest thing around.
Yeah, I think there's an inflection point. And I think that until most great investors, most great businessmen will tell you, you got to go broke at least once in your life. You've got to do it. And I think hidden in that statement is that they assume, Jim Rogers told me that point blank. He came and spoke to my college graduating class at the University of Alabama. And he said point blank, you got to go broke at least once in your life. Okay. So I was a college student. I'm thinking, I don't want to do this. But you know what? It was right. And I've heard it echoed by, plenty of the other investors. What he didn't go into the detail was what I went through in the book. He was saying, well, you'll learn a lot by doing that, and you'll take that to the next venture, and you won't make that mistake again. And all I did was catalog what I went through in losing more than I could afford to lose and putting it down so that other people could then take that and say, once they go through that valley, they can look at something and say, or maybe prevent people from going through that valley and start to recognize when they were slipping down the slope and maybe walk around the valley and not have the episode. But to my mind, it's a book that complements every other how to make money book out there. It ought to be sold in pairs, offered by Amazon. Like, if you buy this how to make money book, you need to buy this one.
Let me ask you this. So you mentioned Jim Rogers, and I had a chance to sit down with Jim in Singapore and interview him a couple of years ago. His daughter, actually, who was 5 at the time, a little blonde girl, sang happy birthday to me in Mandarin, which was quite interesting. But as you bring him up, and he reduces it all down to some very timeless principles, and you're saying, hey, you went ahead and eventually figured out what he reduced to some very succinct phrases actually expands out into a book, and I agree completely. Someone posted on my Facebook, though, about your book today, and they said, yeah, but you know what? Good book, but people still got to go through it because they're not going to listen.
And you know what? And that may very well be the case. But I guess the trick is how many people have gone through it and then sat down and written out what happened, organized it, boiled it down to some principles, and said, I can recognize if I start to slip into this again. And maybe a lot of people have done that. I don't know, but this is the roadmap for everybody who's done that.
Here's what I'm thinking. I'm wondering if it's even if it's literally the book where you say, this is not for beginners. This is actually for somebody who has actually made a mistake. This is for somebody who has lost money that they didn't want to lose money. And now here is the confirmation where you can feel like you've got a friend on your side. Because I almost wonder if the person that has not gone through something will truly be able to accept it all.
Yeah. Well, I guess the same thing could be said. You may very well be right. I guess the same thing could be said for
anything, probably.
All the books on how to make money.
Yeah, absolutely.
Well, there shouldn't be books on that because you have to go through that. In order to make it and keep it, you've got to do it. No manual, no book that you put in front of me is going to, give me the set of instructions I'm going to need to go out there and make a lot of money. I guess I would say that it works the flip side as well.
Yeah. No, it's an interesting it's a timeless set of principles that everyone should read. I know you got to run. You said you're hopping on a train. Is there anything you want to kind of? I mean, the book everyone can find on Amazon. Do you have a web page or anything where anybody can find out more about you or?
Because what happened is like I said, I put the book out. There was I had a web page. You could buy the book through there. And then I now have 3 jobs, and so my time is consumed. And so I did a deal with Columbia University Press, who has reprinted the book. And the Taleb quote is, both quotes, I guess, are in the book, one on the back, one inside. And so they're selling it. And so as part of that, I've removed my presence from the website, and some of my employment now requires me to kind of keep a low profile. So there is some information, I think, on that homepage on Amazon. And then if you Google my name, you're going to find out some of my history and stuff about me. So
okay, I know you got a few more minutes left. So what would be the big takeaway? We've obviously talked through, and it's some complex issues in here, and there's a really fun parable story in here, and then there's some pretty dense material that people really need to wrap their arms around. And say, wow, this is heady stuff. So, but what's a big takeaway? Something maybe that we haven't talked about that comes to mind, either a story, an example, an idea about behavioral finance. Why didn't it seem to like your book so much? What is something that we could leave the audience with as we wrap up here?
Well, I would say this, that after writing the book, after putting out my theory on paper, I said this is all about psychology. So I went to the dictionary and I looked up the word psychology, and it says psychology is the study of the mental processes, behavioral characteristics, and emotions of an individual or group. And I slammed the thing closed and said, that's it. I mean, those are the 3 chapters that I wrote extensively about. These are 3 mistakes that people make. And I go through, what are the mental processes that you go through when you've internalized a loss? How will you recognize that you're doing it? What are the behavioral characteristics of the 5 different types of participants in the market? And then as it comes to emotions, emotions are either good or bad. They just are. But emotionalism, which is making decisions based on emotions, is bad. And the entity that epitomizes emotionalism is the crowd. So I show what are the characteristics of a crowd, and how can you recognize that you're making a crowd trade or a crowd investment, even if you're sitting by yourself in your den. You don't have to be in a group of people to do it. So literally, I can teach the class just taking that definition of psychology, those 3 parts, and show the 3 biggest mistakes that every trader and every investor makes.
It's funny you talk about the crowd as I flip channels here, not right now while we're talking, but as I flip channels in Saigon and I see some of CNN, and it seems like there's a riot or a crowd in just about every country every day. And it seems like that's something exciting and sexy to show people, mobs and crowds of people running around aimlessly. And that's not exactly the way to success. I don't care what the crowd is doing, but it's not good. It's not a good path.
And my point is that you can actually exhibit those traits and characteristics by yourself. And the point is to one, be informed about them, and then begin to recognize when you start to slip into it, so that you don't succumb to that process. So.
Well, listen, Brendan, I know you're going to hop on a train, so I appreciate your time today. And
no, thanks for having me on. I appreciate it.
Yeah, we'll hopefully we'll catch up again in the future.
Great, looking forward to it.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.